Hi, I'm Miranda Carr, Chief Investment Officer at the Trust Company of Tennessee, and I'm going to be covering data for the first quarter of 2026. First quarter performance was really defined by the war in Iran, as energy prices moved up and markets moved down. International markets did hold up better than the US equity market, as valuations there are still modest and their markets are more tilted toward defensive sectors like banks. The rising price of oil caused interest rates to move up a bit on fears of inflation, but REITs really provided that diversification benefit, posting gains as data centers performed well during the quarter. And it's important to note that while the equity market did experience a significant drawdown of about 9% from peak to trough toward the beginning of the conflict, markets did rebound pretty swiftly, even hitting new record highs in April. So analysts began to revise their expectations away from a growth shock and more toward just a fear of sustained inflation. If we look at this chart of the price of oil over the last 20 years in the top left, you can see that oil did spike, but not quite to the levels of 2022, but certainly toward the highest part of the range over the last 10 or 12 years. However, the reason why this is likely not going to derail the entire economy is that we just spend less of our income on energy than we did 50 years ago. The top right chart illustrates this. We've been hearing a lot about the K-shaped economy, and while this rise in energy prices is impacting the bottom 20% income cohort, the reality is that most of the consumer spending in this country comes from the top cohorts, and the increase in gas prices is not causing them to revise their spending. It is causing analysts to revise their expectations for what the Fed will do this year, and currently the base case is that we will not see any rate cuts this year. Remember, higher rates are the main monetary policy that the Fed uses to try to control inflation. So the last thing they want to be doing during a potential inflation shock is to lower rates, especially given that this is a supply side shock. So they don't want to increase demand while supply is constrained. And that revision caused rates across the curve to move higher during the quarter. In addition to inflation, the Fed also must concern itself with employment. This is referred to as the dual mandate. They have to balance the two goals of full employment and stable price levels, which sometimes are at odds. You can see that employment has slowed significantly over the last year. We even saw the economy shed jobs in a few of those months, so very uneven growth here. However, the unemployment rate is still close to 4%, and historically that's a very manageable rate. Immigration policy certainly will mean we see lower gains to payrolls, but as long as the unemployment rate stays around this 4.3 to 4.5% rate level, the Fed really should have no pressure to cut rates. Let's take a brief look at inflation. You can see that this last data point here on the end sticking up when inflation jumped from 2.4% in February to 3.3% in March is nearly all driven by the increase in energy prices. That's that light green shaded part of the graph. In fact, core CPI, which strips out food and energy prices because those categories tend to be so volatile, was up 2.5% in January and February and only up 2.6% in March. So a majority of that increase in the headline number is energy. Now, if oil comes back online in the next couple months, we will see that headline number come back down pretty quickly. The risk here is that inflation expectations start to become unanchored to the Fed's target, and inflation starts to move to other segments beyond energy, which is what happened before. That's what contributed to the high sustained inflation we saw in 2022, and that is what the Fed is going to have to monitor when they're deciding on where interest rates should be for the remainder of the year and into 2027. Now, not all equity markets were down during the quarter. While the main benchmark for US companies was down 4%, some markets were up. The UK index, for example, was up 4% for local investors. So if you're British dealing in pounds, that was your return. And if you're in the US, after translating those returns back to US dollars, you were still up about 2%. So diversification really paid off in the first quarter. If you had exposure to assets other than the S&P 500, you probably had a fine quarter. Now, rates were up pretty much everywhere during the quarter, which may be a little counterintuitive. Typically, when we think of a crisis, the flight to safety trade means investors are dumping equities and buying bonds, which drive bond prices up and rates down. What's going on here, though, is that fear of inflation. So bonds are not a great investment during unexpected and rapid inflation, as we all experienced firsthand during 2022. The good news is that we are starting at a much higher yield, so there's a bit of room for rates to rise before you start to see negative returns due to that income component offsetting the price movement. I also want to point out the chart on the right. So this illustrates that having some diversification in your bond portfolio is wise. The global economy is not a monolith, right? There are diverging growth rates, which means diverging monetary policy, and fixed income returns are also less correlated. So we like having an active manager looking at the global landscape and finding opportunities in fixed income around the globe. And if you don't need the return of an all stock portfolio, you can balance your equity with fixed income and have really strong outcomes over time with considerably less volatility than you would in an all stock or all growth oriented portfolio. This page shows the range of returns over various time periods, and it makes it very apparent that when you're investing for the long term, you have to really focus on the outcomes over the long term. Stocks and bonds can have negative returns in any 1 year period, sometimes very negative. But when you go out just to a 5 year period, in any given 5 year time period since 1950, the worst outcome, if you had bought all equities, so you're just buying into the equity market, would be that 5 years later, you were down 2%. Now, nobody wants that. I get that. No one wants to lose money over a 5 year period, but the probability is on the side of positive returns. And over this period, the average annualized return for stocks is about 12%, and the returns for a 60/40 portfolio and even bonds beats inflation over this period. So you have to take risk to earn a return that is above inflation. And if you set your goals and control what you can control, and one of the main things you can control, by the way, is not panicking and selling your portfolio when things feel dicey or things are down. But if you do this and you let the market work for you over the long term, you do have a very high probability of reaching those financial goals that fund your lifestyle, fund the generational gifting that you want to do, fund your philanthropy efforts, or whatever you want to do with the portfolio. You just need to align the time horizon of those goals with the proper time horizon for risky assets and then not worry about it. Combining stocks and bonds over the long term is a great way to bring down the volatility of your portfolio. We also like adding real assets, which just gives you another arrow of diversification. All sectors of the commodity complex were up for the quarter on the supply disruption, and rates were also up for the quarter. We like them because they have characteristics of equities and they have characteristics of fixed income, and they do offer periods of non correlation. There are many segments of the publicly traded real estate market that did very well during the quarter. Notably, data centers had a great quarter, while office struggled. So even within this asset class, we like to employ a diversified approach. I'm going to end by briefly talking about gold, which has had a remarkable run over the last year. Now, gold is hard to value because it does not have a yield, it's not an income producing asset. It's only worth what someone else is willing to pay for it. So it is more speculative in nature and therefore more volatile, which means it has higher risk. Gold is more volatile than the equity market, significantly more volatile than the fixed income market, and yet since 1988, the annualized return for gold has been worse than equities and a 60/40 blend of equities and fixed income. Only in the past year has gold reached its inflation adjusted high that was set back in 1980, meaning that if you bought gold in 1980 and you held on to it, your gold did not keep up with inflation, which is not true, by the way, of either stocks or bonds. So we understand why people hold it. It typically does well in high political risk environments, but the sell off afterward can be pretty substantial. And I just wanted to explain briefly why gold isn't an asset class that we are super excited about owning. And that concludes my commentary for the quarter. But if you have any questions about how this fits with your financial plan, please reach out to your relationship manager. We are always happy to chat with you about it.